Hey, everybody, we're going to give a few minutes here for everybody to kind of get logged in before we jump off and kind of get going with the presentation. So I got some great panel here to chat on the condo side of things. But in the interim, why don't you in the chat maybe send us a message of where you're coming from. So we'd love to hear where everybody's at.
I would love to know what the temperature is like everywhere. I'm in Denver, Colorado, and it's going to push 80. I'm sorry, 90, which is relatively warm compared to what we've been having recently. And we've had a tornado recently too. I don't know if you've seen that national news. We had a tornado in the suburb of Denver and Highlands Ranch recently. Hot and rainy. That's kind of the theme I'm seeing.
The East Coast theme.
Yep.
Well, I think I'm jealous of the 88 and Hilton Head. That sounds amazing right now.
So I know we were planning to have almost 300 people attend this Condo 101 class. So again, we want to make sure we give everyone some time and make sure we deliver some great content. I know everyone has questions about condos.
Perfect. We'll give them another minute or two here more and we'll get going, guys.
Yep. Thanks, Jordan. Again, if you just joined, would love to have you enter some information about where you're coming from and kind of what the temperature is like today. So again, would love to hear from you, and we are going to keep this chat running. So as you hear information, have some questions, please type in some comments, and we'll have a chance to put those comments to the panelists as we go through. See some familiar names, and again, we have loan officers and realtors on this call. So great to see again a collaboration of people trying to get deals done in this challenging market. So this is great.
Perfect. All right. Well, I want to make sure that we respect everybody's time here, and we'll kind of get this going. We thought there was a lot of value and importance with today's kind of market conditions and what we're seeing to kind of chat on the condo side of things. I think there's a lot of misconceptions surrounding warrantability of condos versus non-warrantable. And I think condos are a crucial part of the housing process in terms of helping first-time home buyers get into the game, right? Every day that we have somebody who's outside of home ownership is a day that they're losing out. So I think that it's a good place to, with elevated interest rates and high home values, to get some of those first-time home buyers in, and there's also obviously second homes and things along those lines, but kind of where this whole conversation initiated from. So today, kind of on the panel, we've got Joey and Ian who run our condo department here within Movement, and our rock stars. I personally have had many deals that have been told could not be done at other lenders that we've been able to get done. So they're going to be kind of speaking to that. I also have Chad, who's a branch manager here in Colorado, who's kind of going to be monitoring the chat. There are going to be a few points throughout the presentation that Chad will kind of jump in and bring some questions up, and would love to hear kind of anything that you guys are seeing going through with regards to condos. And Chad will definitely integrate those questions in throughout the process. But now I'd love to turn it over to kind of Ian and Joey and let them kick off, kind of the value of the process with movements in the condo department.
All right. Thank you, Chad and Jordan, for having us today. My name is Ian Westcott. I'm the condo project analyst manager for the West Coast, and that guy over there.
My name is Joey Durant. I'm the condo project analyst manager for the East Coast.
All right, so we're going to kick off this presentation. Let me share my screen.
Put the phone on silent, be professional, right?
Yeah, that's always beneficial. All right, guys. So keynotes on condos. Today we're going to be going over just, some conventional jumbo FHA, VA, some common myths and misconceptions, and what makes the movement mortgage condo department unique. So Joey, we're going to hit them off with the basics, starting at a high level. What is a condo?
Very simply, it's a type of legal real estate, not a style like a townhouse, but an actual legal form of real estate. Same as a single family, same as a PUD, but a condo is its own form of real estate. And what differentiates a condo from everything else is you're buying just the airspace of your designated unit. Whatever your governing documents that your developer created to say that the unit includes this space between these walls, between these floors, between these ceilings. That's what you're buying. You're buying your unit to live in and occupy together with a shared undivided interest in the common element, which is everything outside of your unit, but still within the project.
So with a PUD in a condo, because we get this question all the time, just about every day, if not multiple times a day, what's the difference? You explained the legal definition of a condo and that a unit is conveyed to an owner, but with a PUD, there is a big difference, right? Like what can create a PUD versus a condo?
Land,
right?
That's the difference. Yeah, a PUD, your unit is going to be defined as the parcel of land together with the improvement. A condo is never going to identify the unit as a piece of land. The condo is always going to identify the unit as the airspace of the internal structure that you're going to occupy.
Okay, so one of the easiest ways we're able to tell the difference between a condo and a PUD is reviewing those legal docs, right? The CC&Rs, the master deed, the declaration, whatever you want to call it.
Exactly.
We look to see how an owner in a unit is defined and essentially look for that keyword condominium within those legal docs, right?
100%. And what trips up everybody, myself included, is sometimes we look at townhouse style projects, and again, townhouse is just a style, just like Victorian or a bay or whatever, it's just the style. Townhouse is just the style.
This right here, right, Joey?
Exactly. So this is a townhouse style project. And we wouldn't know if it was a condo until we saw the legal description, the governing documents from the HOA, perhaps some recent title work, some preliminary title work, to kind of ascertain, how a title is going to treat it, but townhouse is just the style. It's never a legal type of property.
Right. So guys, what we really want you to take away from that little verbiage Joey just talked about with townhouse being a style, if you see the county identifying the property type as townhome and you're not sure whether it's a condo or a PUD, you can always reach out to a title rep. You can always look at the legal description for the tax bill. You could also always reach out to Chad, and Chad could do a little Scooby-Dooing with the condo department.
Jinkies.
And then we have this other property type, Joey. I mean, we just talked about the difference between condos and PUDs, and this looks like a single family standalone home, right?
You would think that, except I happen to know what project this is. This is actually a site condo. And what's really unique about site condos is A genius developer up in Michigan came up with this plan to put more houses on the same, piece of the same parcel of land as he was developing. And he went to the county, and the county said, okay, well, you got to have lot lines if you're going to do single families, but you don't need lot lines if you do condos. And the developer turned around and said, you know what? I can do 100 site condos in the same space. I can do 40 single family homes. They just don't have a yard. Let's do it that way. And hence form this property type of site condos. Now, what's really cool about site condos is they're treated just like single family homes. There's no project review requirements. There's no budget review requirements. We just have to, make sure that we're, servicing the loan as a condo because it is legally a condo.
Unless it's VA, then we need a VA submission, unless it's in Michigan for every condo. So there's always exceptions to the rule.
Too deep. You got, if you keeping it up here, keep it up here. Yeah, there's exceptions to every single rule, and there's exceptions to those exceptions. And we're going to get into that when we talk about what makes a project warrantable.
Right.
Yes. Most site condos are fee simple. You don't really see a lot of site condos on a leasehold estate. No, but that is a very good question.
All right, guys. So now what we're going to do is we're going to give you a little why behind the what, like what lenders look for when it comes to conventional and jumbo financing, more specifically movement mortgage.
I got a question for you, Ian, for this next slide. It's a good segue for you.
Yeah. What you got?
Why do condos need to be approved?
Right. So that is a great question. So the reason why agencies want lenders to do a project-wide review is because when an owner is buying into a condominium, they're not just being conveyed that unit, they're being conveyed an undivided interest in the entire HOA community. That HOA is responsible for expenses, maintenance, insurance, and anything else that the HOA is governed to do. So with that being said, the agencies want the lenders to do a review of the project to make sure it meets their requirements for owner to be able to, or a buyer to be able to go in there and purchase per the guidelines.
So like risk assessment, the same as a borrower has to meet credit worthiness, the project has to meet risk assessment and, basically credit worthiness as well.
Yeah, exactly.
Okay.
So condo review documentation for conventional and jumbo financing. We're going to be getting a questionnaire, a budget, and the project insurance. If it's in a resort market area or a new project, we're going to need the CC&Rs, bylaws, and rules and regs. If it's a new project in Florida, a PERS approval is automatically required. And a Fannie Mae PERS approval is an agency level review. So we've got two reviews that we can do with our conventional loans and our jumbo loans. It's full review and limited review. Full review is an approval that allows lenders to utilize minimum down financing options with that agency, Fannie, Freddie, or that jumbo investor. This is an approval that's good for 12 months on established projects and 6 months for new projects. Our approval is exclusive to movement. No other lender can utilize our certification to close loans in there for their buyers or their clients. They would have to approve that project themselves. And we'll get into this a little more, but other lenders likely have overlays. So just because movement can do it does not mean another lender / bank can certify that project. Joey, we got to hit them with the limited review on what that means and what we do and don't review, etc.
Yep. Now, limited review does not mean limited documentation. Limited review just alleviates the lender from having to certify a few data points. Fannie Mae and Freddie Mac recognize the additional risk by omitting certain data points like the dues delinquency or the reserve allocation on the budget and certain insurances. And they say, okay, well, as long as the borrower is eligible for limited review and, can do the limited review, then and the project meets limited review, we can still do this loan. But that's really the only difference between a limited review and a full review is the reserve allocation listed on the budget the fidelity and general liability insurance coverages, and the amount of units that are currently delinquent on their HOA dues more than 60 days. Also, what's kind of a hidden gem into the guideline updates from 18 and 19 is when they opened up limited review for investment purchases. By doing that, they allow us as the lender to completely ignore the investor concentration on an investment purchase. So even if a project is 100% investor owned with 100% rentals, we can still do an investment purchase in there using a conventional loan product.
Now, so let me ask you this. I appreciate the clarification. It's a limited review in a sense to it. We're not reviewing everything for the project, but it is still an entire project review, correct? So
yeah, it's still, we're still reviewing the entire project. We're not reviewing a building within a project or a unit within a building. We're still reviewing the entire project as an entity.
and if we had an investment occupancy transaction, the rental ratio was 80%. The delinquencies were at 30%. The fidelity coverage was short, and there was no reserve contribution. Could we do anything?
Yeah, you can still go limited review. Every one of these data points can be, an issue, and we can still proceed with a limited review. Every single one of these data points can be an issue when we initially do a full review, and we can advise the borrower, hey, this is how you get past those issues.
And how do you get past those issues, Joey?
Put down more money. It's as simple as that. The LTV is what dictates whether or not we can do a limited review. So borrowers doing primary purchases or refis outside the state of Florida is 10% down for owner OC primary, 25% down for second home or investment limited review outside of Florida. And yes, Florida is a little bit more strict. They want 25% down for owner OC primary and 30% down for second home or investor for limited review in Florida.
But guys, any Florida LOs or agents in the chat, don't hesitate to reach out to your movement loan officer, and the loan officers don't hesitate to reach out to the condo department. There's options for secondary financing for limited review that we can provide more details on if you reach out.
Yeah. But that's the only difference is the LTV. If the borrower is putting down enough money, even if the borrower is not putting down enough money initially, if we come across one of those issues, Fannie and Freddie say, you know what, put down more money. You don't have to re-originate. You don't have to do a new, anything like that. It's just change the LTV, make it eligible for limited review, rerun your AUS and let it ride.
Right. As Joey mentioned, we are mitigating the risk per agency guidelines by requiring more money down. So again, you have a 25% down investment transaction. We are not worried about, that's my LOS. Sorry about that, guys. We are not worried about the delinquency, the rental ratio, the reserve contribution, or the liability or fidelity insurance, guys. So that is the difference between full and limited, and what we have to review and what we don't have to review for full and limited. And now here's one of the main talking points. One of the biggest changes that we've seen come up in 22 and 23, deferred maintenance special assessments, guys. What's the difference between routine and deferred maintenance? And what are we looking for in our condo process when we come across special assessments and deferred maintenance? I would say the quickest thing that we did when these updates came out is we updated our questionnaire to go more into depth in regard to special assessments and deferred maintenance by asking about if they've been put on notice, if they're aware of any deficiencies, have they had any, financial distresses in the past. And we kind of take all of that and look at it from a high level. But Joey, can we give them a couple of key points in regard to the difference between routine and deferred maintenance?
Yes. The biggest difference between routine and deferred is the planning. If the HOA is following the recommendations of a reserve study that they had done, and they're, doing a special assessment according to the reserve study to pay for a project that is, new fences, new balcony rails, new siding, new windows, new roof, because it's time to replace the roof. So the biggest difference between routine and deferred is planned. If the HOA has the plan in place, and even if they're doing a special assessment to take care of this plan, if it's a plan, if they're doing it ahead of time, they're being proactive, that's not deferred. Deferred is the county official came out and said, hey, the foundation is cracking over there and your parking garage is about to fall over. You need to get that fixed. Nobody can occupy this building until it's fixed.
Right.
That's deferred. That's a critical repair that the HOA is required to take care of in order to become code compliant. Or if speaking of code compliant, if they didn't pass their 40, 30, 50 year out in California every 8 years for foundations and balcony stuff.
Right.
Every state has their own little version of a regulated inspection that is done. Surprisingly enough, way before Champlain Tower tragically happened, these inspections have been going on. And these guidelines are just kind of reinforcing the results of those inspections to make sure that buyers are aware of any issues.
Right. We want to make sure the projects are structurally sound and there aren't any obvious red flags for work that the HOA should have done long ago.
Yeah.
We want to make sure the HOA, when they do have a special assessment or there is work going on, that funds are in place for them to facilitate said work. And, if there are any engineer reports or inspections, we would be taking a look at those to make sure the project is structurally sound and there are no unsafe conditions referenced.
And that's the long and short of it, guys. Fannie Mae and Freddie Mac are sort of aligned on this. They're aligned on the basic front of our HOA structurally sound. They're not very aligned when it comes to how we are allowed to document the loan file, but they're aligned on the forefront of we don't want to approve any projects that are structurally deficient.
Correct. All right. Another one that I know is a pretty big topic for you guys. You guys have got Vail, Breckenridge, Steamboat Springs, you name it, you've got it around you. And resort condominium financing, the difference between Fannie and Freddie is the key here, and how we are able to do some of these loans conventionally still.
Yes. According to Fannie Mae, if you can Google the project and rent a room there, or if you can, see the ocean or see a ski lift, you're basically a hotel. There's really lots of resort condotels in Florida. So lots of sand. We would have to, in order to take a project in a resort market going Fannie Mae, we would have to unequivocally prove that either the HOA prohibits short-term rentals altogether. In order to go Fannie Mae in a resort market, it's not a tall order, but it all depends on the rules and regulations of that HOA.
Right.
Freddie Mac is a tad different, a tad more lenient when it comes to resort market areas. They still put the earnest on the lender to prove that the HOA themselves are not involved with facilitating, partially managing, co-managing, contractually obligated in any way, shape, or form to facilitate any short-term rentals that may or may not be happening within that project. There has to be a clear separation that if there's units being offered up for short-term rental in the project, that the HOA has nothing to do with it. It's all being done at the unit owner level specifically, and not at the HOA level. There's no third-party agreements, lobby space being rented out, or anything of that manner in order for Freddie Mac to consider a project residential and not a condotel.
The big difference is Fannie Mae, like Joey said, Fannie Mae specifically has a guide that they wrote into their policy about if there are any online short-term rentals available, if it has an online rating from a travel agency. So, I mean, a lot of the times when you Google these resort condominiums, they can show up on Travelocity, Booking, Expedia, you name it, and that really just rules it out for Fannie Mae. Another big difference is Fannie Mae doesn't allow any transient verbiage like lodging, resort, hotel, motel, in the name of the condominium, that or the master condominium or the master HOA. That automatically is a deal killer for Fannie and not so much for Freddie.
Unless there's some historical reference to the name, and even then we'd still,
Right.
be required to ask Fannie Mae for a direct review, either through a streamlined a per submission or a full per submission.
And we mean like a hotel from like 1920, not that the
Yes.
area itself has historically been a resort area. And then also, guys, for the true condo tells,
Yeah.
we've got a non-warrantable in-house fixed rate condo program that allows for condo tells that have a front desk, that have maybe they receive rental commission from the owners, or they have a mandatory pool, or they still have some timeshare units in the project. Our non-warrantable investor will allow up to 20% of the units to be timeshares. And this is all an in-house non-brokered program.
Yeah, but that's only for established projects, right?
Correct. Established resort condominiums only.
Yep. But what's really cool about that program is they also allow mandatory memberships. So I think somebody was asking about HOAs next to the golf course. If the HOA is required to have that golf course membership and the HOA doesn't own that golf course, we can still proceed with those as well.
Correct. All right, at this point, do we have any questions on conventional, jumbo, deferred maintenance, resort, what a condo is, isn't?
I think we've done pretty good at answering the questions as they've come through the chat. We had that recent one about the golf course.
Kimberly Robinson, the on-site maintenance. If we run into this all the time, there's actually a project that we like in Ocean City that has an on-site handyman, and they pay, the HOA owners pay for that service to have that access to an on-site handyman. It really is on-site maintenance personnel and company. So that's fine. We've done a bunch of loans in that project.
So long as it's not like a handyman that unlocks doors for, short-term rental tenants.
I mean, I'm not, I didn't hear nothing.
There was a question about ACV on master policies.
Oh man,
Man.
is that already coming up?
I got this one, dude.
Is that already coming up? Go
This
ahead.
one.
Go ahead.
So actual cash value, we're seeing this in Florida and along, the Gulf Coast and a lot of areas where insurance providers are just no longer insuring the roofs in those markets to replacement cost, and they're only insuring them to actual cash value. That is a problem for Fannie and Freddie financing right now.
It's also a problem for our in-house non-warrantable product as well.
Correct. Even if the project is currently Fannie Mae approved, Fannie Mae tells you that they don't review insurance, and the lender is required to review insurance to Fannie Mae guidelines, and ACV on roofs is always an issue.
Do we have a list of approved movement condos anywhere?
Oh yeah, just email condo concierge at movement.com. Or your loan officer, and have your loan officer email condo concierge at movement.com. It is an internal list. There are caveats and disclaimers, and every one of our approved condo projects are still subject to, if we're made aware of any material changes that do impact the, approval. Yes, but we do. Just email your loan officer, and your loan officer can get with condo concierge.
Get you that list with the quickness.
Yes.
Something that wasn't posted, but when we possibly get a appraisal waiver on a transaction.
I love this question.
Does that change the process of the condo approval?
That's my favorite question. Okay, so we get this question a lot, and it tickles me every single time, because I've only ever known this way of doing condos, the movement way, but we hear about it all the time, where other lenders jumble the appraisal and collateral review of the condo all in one. But no, our process is upfront. We can do our condo review, our questionnaire is designed, even if we're not using our questionnaire, we're using another questionnaire, there's other data sources that we can access before we rely on an appraisal. But we can do our condo review and approval of the project completely independent of needing any appraisal. So when there is an appraisal waiver, it actually makes our job easier because we don't have to prove our findings are any more different or contradictory of the appraisal and go get appraisal revisions. So we love it when there's an appraisal waiver.
Right. It's
Awesome.
our process was not built around the appraisal, and that's one of the differences here at Movement that we definitely dive into with the why behind the what regarding the creation of the condo department.
Great.
A market trends question here, guys. Have you seen over the last couple of years either an increase or decrease in deferred maintenance, as well as an increase or decrease in people purchasing second homes in condos with the changes that Fannie Mae and Freddie Mac have made with regards to second homes?
Right. So I think with deferred maintenance, it's kind of like one of those things where you get a brand new car and then you start seeing that car everywhere. Maybe you didn't notice it at first, but now that we have to review for deferred maintenance, special assessments, I think we're seeing it come up. Yes. I mean, I'm sure Joey would agree. It's something that we see. I wouldn't necessarily say it's more common than when we saw it in the past. We just have to review for it now, which is why maybe that's why like sales and agents are seeing deferred maintenance more. It's just on their radar now. But you know, special assessments and routine maintenance have always been a thing.
Yeah. And I haven't seen any decline in the second home purchasings in the majority of our markets. You know, it's still one of the most affordable things you can buy as a condo. You know, the average unit price of the condo is still way below the average unit price of a single family. So it's still, you know, one of the most affordable things you can buy.
Right. And we're still seeing a lot of second homes and coming through in a lot of, you know, the resort markets or the second home markets that we do condo business in. So the volume is still there. People are always going to be buying. All right. Any other questions? Are we ready to move on to the FHA VA section?
I think we are ready to move on, except one last question. With California, where the HOA master policies are not being renewed.
Same as the ACV.
Yeah,
Fannie Mae and Freddie Mac don't have an answer for it yet. It's insurance, and you know, the only workaround for the insurance issues is if an HOA were to purchase like a citizen's policy, because like literally that would be the only insurance they could absolutely buy. And you know, from what we've been reviewing, especially with the wildfires and with the Cobra flood zones, it's not that no other insurance is available for them to purchase. It's just that instead of their insurance premium being, you know, $20,000 for the HOA, it goes up to $520,000 for the HOA. So it is obscenely just ridiculous how much the insurance premiums are jumping up because of the, you know, the recent natural disasters or the new flood zones and layouts and things like that. And again, it's obscene that the insurance premiums are jumping up like that. But it is available to purchase. And that's what Fannie Mae and Freddie Mac are trying to figure out a way to better facilitate that particular portion of the guideline.
Right. It's tough. What these brush fires have caused insurance companies, like Joey said, to like cause their premium to increase 30 times, you know? And so at that point, the HOA used to have 100 million in building property coverage, but they could only afford the premium on a $5 million policy. So that's all that they have. Unfortunately, when we see that, just like the ACV, it's a problem because Fannie, Freddie, really all the agencies want to see that the HOA has insurance that's equal to 100% of the replacement cost of all the property on the condo grounds.
Great. Well, let's dive into the next section.
All right. FHA and VA financing.
My favorite.
Man, so Joey, we've got FHA and VA. We like VA. I'll talk about VA here for a little bit.
Go ahead,
And
go ahead.
so Joey kind of touched base on VA. Regardless, you're going to need a VA approval on a condo project, whether it's a 2 to 4 or a detached or 1,000-unit condo project. The only exception is a site condo in the state of Michigan.
Or a VA Earl.
Or a VA Earl, of course.
right.
Yeah, of course. Or a VA Earl, a VA refi. This is an approval where we have to gather the docs and we electronically submit them to VA through the VA portal. And it's about a 4-week turn time for VA to review. We are seeing their reviews come in quicker, but their advertised turn time is 4 weeks. Would you say you're seeing them take about 3 weeks, Joey? Maybe
Right now. Yeah, right on the 3-week mark. They're turning them out.
And then the other great thing is the VA approval, once a project is VA approved, is good for life.
So what do we need to document at the lender level when we come across a project that's already VA approved?
Just the master insurance policy for the condominium.
No questionnaire, no budget, no meeting minutes, no reserve studies, no nothing.
Correct. After VA approval, there is no lender level review, which is very different than FHA, which is a good conduit into FHA financing, Joey.
Yeah, so when a project is already FHA approved, we were still required to do a lender level review to ensure continued compliance with the current version of the HUD handbook, which means a short questionnaire and the master insurance, just to certify to FHA that we're delivering them a loan within a project they reviewed, that this particular loan and the project still complies with their guidelines for single entity ownership, litigation, special assessments and deferred maintenance, insurance, things like that, dues, delinquencies. So, even if a project is already FHA approved, currently FHA approved, we're still required at the lender level to do a continued compliance certification. If a project isn't FHA approved, we have a couple options. We have a couple routes we can go. We can gather up all those documents and electronically submit them to HUD, whatever vernacular you prefer. It's, depending on the type of the project, the status of the project, conversion, new, established, whatever the case is, it's anywhere between 13 and 17 documents electronically submitted up to the HUD. Now, before we do that, though, before we submit anything here at Movement, we try to do the single unit approval, the SUA, what used to be called spot approval, on every single one of these FHA bad boy loans. What's really cool about that single unit approval is we can review at the lender level with more restricted guidelines than if we were to submit for a HUD review. And if the project meets those more restrictive guidelines, we can get a case number assigned without having to submit a whole package and wait 4 weeks for FHA to review it. That's why we love it. And we try to do that on every single one of the FHAs. Now, like I said, there are more restrictive guidelines to do a single unit approval, or what used to be known as a spot approval. So not every project is going to meet those more restrictive guidelines. Just because you don't meet the more restrictive guidelines for SUA doesn't mean we're not going to still submit for HUD review and approval, or HRAP, on every single one of those. And their current turn time is up to 30 days for initial review. And if they have any reconditions, but that's FHX, and it's still a really, really valuable approval, because Freddie Mac and Fannie Mae will accept an FHA project approval. You need an FHA project approval if you're going to do a HECM or a reverse mortgage in a condo. It's good for 3 years at a time. You only got to do it once every 3 years. And
Now,
it's free. It's free. FHA and VA don't charge for project submissions, guys. I don't know who came up with this thing. It costs thousands and thousands of dollars for your project to be FHA. No, it's free. FHA and VA do not charge the lender. They don't charge the agent. They don't charge the unit owner. They don't charge the HOA. They don't charge the property man. FHA and VA don't charge for you to submit a package to them for them to review your HOA.
right. And we will put those packages together on deals live or pre-submit, and we'll get into pre-submit here shortly, but that is a really important thing. I'm glad we touched on and emphasized this is free. There are retired real estate attorneys that'll go around to HOAs marketing a service that only costs $6,500 and they'll get them FHA and VA approved, but they're an outside independent third party. We at Movement do not charge for that service.
Yes, FAR and HECM, they will, you can do a single unit approval for the reverse mortgage.
All right. We already answered one question. Any other questions on FHA or VA condo financing?
I think we just had a question about where do we get a list of docs needed for the single unit approval?
Oh, just Google the HUD form 9991 and 9992. The documents required to be submitted with that questionnaire are part of the questionnaire. Or touch base with your movement loan officer and have them hit me up on Condo Concierge, and I got a neato burrito little checklist that I can send out.
Great. The question was, so FHA and VA are okay with ACV on master policies?
No, they're not. FHA requires 100% insurable replacement cost valuation being covered. So as far as to they even go deeper on that, they require RC, but they also require an agreed amount endorsement if you have a co-insurance policy for FHA. VA, oddly enough, follows the insurance requirements set by Fannie Mae. So they're going to, have the lender certify that it meets the Fannie Mae insurance requirements.
Great.
But one thing we forgot to talk about for VA is even if a project gets rejected, let's say it gets rejected for like rules and regulations or a provision for
an approval.
What's the right of first refusal? That's a common one. VA doesn't like the right of first. VA doesn't like any restrictions on transferability of title whatsoever. They don't like rental restrictions. They don't like any restrictions, but they want their veteran to go in and buy a unit and be able to do whatever he wants with his him or her, or whatever they want to do with their unit. Okay. VA doesn't want any restrictions. So if the HOA has certain restrictions in their governing documents that VA doesn't approve or doesn't agree with, and they reject the project, they'll call us, they'll email us, they'll say, hey, the veteran really wants to live there. Have them call me. I'm gonna talk to them why I rejected it. And if they still want to live there after I talk to them, we'll give you an exception. You can issue the NOV, but we're going to leave the project rejected in the system. So VA is still offering on rejected projects. If we get it rejected, if we submit the package, if the veteran still wants to live there, not a problem. Most of the time, 9 times out of 10.
Right. Unless it's like construction.
Unless it's construction defect litigation. Yes.
Another question came up for VA. Is VA approval for individual condo approval or complex approval? What if the VA approved?
Right.
And you can see a ski lift.
Fantastic question, Gary. Yeah, VA doesn't care about resort areas. I got half of Myrtle Beach VA approved.
Right.
Right in. I got high rises with 40% commercial space VA approved in downtown Virginia Beach. The VA doesn't care about minor things like, the VA wants the veteran to live somewhere that they want to live and be able to do what they want with what they buy. They're very, very, very high level, which is why once a project is VA approved, it's pretty much VA approved for life. You got to do something pretty messed up to get your VA approval revoked, is all I'm saying, or suspended, like construction defect litigation.
And then the last one, I think we maybe touched on it, but as far as investor concentration, how does that affect VA or FHA?
So
same.
yeah.
FHA, go ahead.
Oh, I said VA, the cap is 50%, right? But they'll
On a new project.
Right. They'll go above it.
Yeah.
But we've got to do the VA submission.
Yeah.
FHA, the max rental ratio for single unit approval is 50%. And then HRAP package submission is 65. The other concentration to keep in mind with SUA is the FHA concentration.
Yes.
It's capped at 10% of the units in the project. So once that 10% FHA concentration is met, no more single unit approval. An HRAP package has to be submitted for another HUD loan to FHA loan to close in there.
I think that was the old rule too, under the spot approval. You couldn't have more than 10% spot approval concentration.
Exactly. That's exactly that. That's exactly where that rule came from.
Okay, great. Well, let's move on.
All right. So man, so now we're gonna get, we wanted to give you guys a little bit of knowledge on condominium financing to help you kind of understand why and how we set up our department the way we did. We've got a dedicated condo department. We only work on condo eligibility. We communicate with the sales team on the file regularly. When we order docs, our ETA, when the docs are in, if everything looks good and the project is approved, or if we had to reach back out and ask for anything. The whole point is we have a dedicated team so that we can communicate as much as possible along the upfront process. We aren't waiting on borrowers to be approved or the appraisal to be in. As soon as you guys utilize Condo pre-submit or submit your deal, we are upfronting the file to order docs so that we can review as soon as they are in. Now, we also do legal reviews for new projects and projects engaged in active litigation.
Yes.
A lot of that.
Lots of that.
Oh, Joey, now we get to go into operating directly to agency guidelines, but what does that mean, man? I hear a lot of buzz about non-warrantable from, sales and agents, but we need to dive into that.
Okay. All right. So non-warrantable, right? It's a lot easier for XYZ bank to turn around and say the project is non-warrantable. But what they're really saying is, yes, I could do this if the project met our internal rules for investor concentration or single entity ownership or litigation or commercial space, investor. Yeah, like I could do this project because it meets Fannie Mae guidelines, but it doesn't meet our bank's internal risk assessment rules. So that's why
go over too well, right? If they
that's not going to work. They're not going to come out and say, yeah, I could do this project, but my bank has rules above and beyond what Fannie Mae and Freddie Mac advise on their guidelines. So that when we talk about warrantable, when movement says warrantable or movement says non-warrantable, it's gospel to the guidelines. We can quote exactly what paragraph, what sentence, what page of whether it be the Fannie Mae or Freddie Mac selling guides to say this is the rule that we're showing that this project is in compliance with. So the ineligible characteristics, there's 17 of them, and all 17 have additional 17 pages of allowable exceptions. Litigation is my favorite to talk about. There's this weird concept out there where any project involved with litigation is a rubber stamp denial without any further explanation whatsoever. But not all litigation is construction defect litigation, and not all construction defect litigation is completely non-warrantable as well. Fannie Mae and Freddie Mac explicitly define minor litigation versus major litigation. So as long as we can prove that it's not impacting the structural safety, habitability, functional use, or marketability of the project or financial solvency of the HOA on a go-forth basis, it's minor litigation. It's plain as day. If unit owners arguing over, quiet rights of enjoyment and noisy neighbors, minor. Unit owner suing the HOA because he wants his parking spot reassigned because his convertible is on the tree line, and you can kind of fill in the blanks there. He just wants a new parking space. Minor. Okay.
Right. all rescue scenarios too. All legitimate rescue scenarios. And another one of the common misconceptions, we already touched base on it, was the The rental units, the number of rental units in the project. Oh, we can't do this second home deal because the rental ratio is 75%.
Doesn't matter.
It could be 100% and you can still do 10% down for second home. You could still do 5 or 3% down for primary. It's only when it's an investment transaction does that come into play. And even then you've got a workaround with the limited review, more money down.
Yeah.
So there are a lot of overlays out there that agencies put on top of guidelines, that lenders put on top of the agency guidelines, but those lenders don't tell you that it's just non-warrantable for them. They just use the blanketed phrase because it sounds better.
Yeah.
Than them saying we could do it, but we're not gonna.
And special assessments aren't deal killers. They really aren't. We see special assessments 20 times a day, especially with the whole insurance debacle going on right now. Every other project you review has a special assessments for increased insurance premiums for either this billing cycle or next billing cycle. They're just getting ahead of the game. That's not a deal killer. We just have to prove they're collecting it. That's it.
Pretty easy.
Yeah.
Oh man, this is the perfect conduit into condo rescues, Joey. We just had we dropped a video last week of one of our loan officers up in Rhode Island doing 4 rescues in 2 weeks. Let's talk about.
I'd rather talk about the one we rescued last week in Florida, where the HOA didn't want to fill out the questionnaire.
Oh yeah.
The other lender denied it because they didn't want to fill out the questionnaire.
They didn't want to answer if they were on notice or if they were aware of any deficiencies, and it was in Southwest Florida. We just did a Miami-Dade citation lookup because thankfully their county website has that option.
Yeah.
And we didn't find any citations in the name of the HOA. We had a strong supporting appraisal with that subject property and the comps in the same condominium, as well as the budget. It was a strong project. The HOA just didn't want to be liable for answering questions one way or the other.
Yeah, and I mean, like, there's tons of sources of data, the county records, the county lookups, the code violations, the code building code inspectors, the title, previous closings, previous appraisals. We didn't even have to wait on the appraisal for that particular file. We had a previous appraisal in that project from 3 months ago that we had that we were able to reference before we told the borrower, yeah, go ahead and order appraisal. I got you, no problem. We're good on this one.
Right. And I mean, the thing to keep in mind, so from an agent perspective, let's say your buyer you were just told by the lender that, the condo project is denied. Turn around and ask that lender for the questionnaire, budget, and insurance, and send that to your movement loan officer, along with the reason as to why the other lender is saying it's non-warrantable, and we'll review it. Same day, on the spot, within an hour. Just, email the condo department and we'll get it looked at. We rescue several deals a week with condo scenarios. Another one from last week was they had a high delinquency rate, but they were already putting 30% down on an owner-occupied deal in Washington. The lender tried to tell the buyer's agent that the buyer needed to pay down 6 of the delinquent units, and then they could close in there. We told them they were already good for limited and the delinquencies were a non-issue, and the buyer didn't have to pay down $15,000 worth of delinquencies in order to close in there. We were able to rescue that deal, as is, no more money down. But of course, that lender told that buyer's agent, oh, this condo is non-warrantable. Not what Joey said. Well, it meets agency guidelines, but our guidelines won't allow it. Because I imagine that would send everybody through the roof. So this is how we rescue condo deals, guys.
No overlays, directly to whatever the agency guidelines of state. Public knowledge, public database, Google Fannie Mae guides, Freddie Mac guides, USDA, FHA, VA, whatever the guides say, that's how we underwrite it. Black and white.
Condo pre-submit, Joey. Oh man, we got to touch on this.
Go ahead.
All right, so let's say you have a buyer and they're looking at condos, like Jordan said at the beginning, it's an affordable price point. We're making sure we're providing our clients with options as they shop. And you want to make sure when it's a condominium that there are no last minute surprises, which is why you utilize movement, because our process is up front. We don't wait for anything to come in from credit or collateral to do our condo review or start our condo review. But on top of all that, we've got condo pre-submit. You let Chad or any other movement loan officer take your buyer's application. You give them the name of the condo project they're just waiting on a listing to show up in, and we will get the project reviewed. Along with the name of the condo, we're gonna need an address within the project. We're also gonna need a phone number for who we need to reach out to.
Yep.
And then the sales team submits the condo pre-submit. We order docs within 24 hours. We treat it as if it's a live deal. So the docs are ordered on a rush, the quickest rush option available through the management company. And then we review said docs within 24 hours of receipt of that, of the questionnaire, budget, and insurance.
Who pays for all that, Ian?
Movement does. We front that cost and we only charge the borrower at closing.
But what if it doesn't get approved? What if we can't approve that project for that loan program they want to use?
Not a problem. Movement will eat that cost. The client or the agent aren't paying, and they can continue shopping. And the great thing with condo pre-submit is you guys can even utilize this for FHA and VA. If they're not already FHA or VA approved, maybe you want to look at a single unit approval, eligibility, and we can get the ball rolling with that as well.
Sounds like a pretty fair deal.
And then Joey, we've got working with developers, man. We love this.
This is our favorite. This is our favorite. Ian and I are on Zoom calls at least twice a week with developers. And what's our favorite thing about this is, imagine all the heartbreak and heartache that is caused by a developer working with a brokerage that has no concept of condo warrantability. They get all these pre-sales put together with their brokerage and then turn around and they can't close on any of them because the condo project doesn't meet Fannie Mae, Freddie Mac, FHA, or VA guidelines.
We're
So
talking
what
about
we
like silly things too,
silly
like
things like
no
implied
income on the
approval,
budget.
implied approval at 30 days, or a 5% reserve allegation because it's a new project. And why do we need a 10% reserve allegation if it's a new project? Yeah, stuff like that, silly things. So like what we like to do is get in before ground is broken. If you're working with a developer, we're working with that developer directly, when the drafting is beginning, when we're thinking about how we're going to form these governing documents and phasing of the project. The more phases, the better, or one big project or 5 small projects and then combine them when they're all together, like they do in Florida. That's how they get past the PERS requirement. They build 5 small projects, and when they're all built, then they combine them all. Okay, that's how you get past that. But those are the conversations we have with developers. And what's really fantastic about that is, we just got to give them that they need that chance to see what we can do on a condo. And once they see what movement can do on a condo, imagine what movement can do on an easy single family.
So many lenders are quick to tell developers and agents, oh, this is a new project, it's non-warrantable. I do not like using that word with the new project. I know Joey doesn't either, because 9 times out of 10, it's just a waiting game. Completion isn't met yet for the phase or the building, and maybe pre-sales aren't met yet. That doesn't mean it's non-warrantable. That means it will be warrantable once pre-sales and completion are met. But so many lenders are quick to just say, hey, this is non-warrantable. Here's my non-warrantable broker option. We can close with these, no problems. But here at Movement, like Joey mentioned, we take the time to work side by side the developer while you guys are working with the broker, or, while our loan officers are working with the agents to get, the pre-sales pre-approved, pre-qualified for loans to make sure that they can actually finance on that unit. And what we do is offer this consultation at no additional cost, right, Joey?
Exactly. Exactly. Again, there's there's agents out there that still think that that this type of service and consultation can cost thousands and thousands of dollars, and I'm sure it's valued at thousands and thousands of dollars. I know I'm worth thousands and thousands of dollars for my short time in consultation, and absolutely. But that's it doesn't cost money to have a conversation and reach an understanding and create more houses for people.
Working with developers, guys, we love it. Pre-submits, rescues, and working with developers. So in conclusion, we review projects for conventional, FHA, VA, USDA, and have programs for non-warrantable condo financing. Joey touched base on this. Non-warrantable condos like condo tells, excessive commercial space, excessive single entities, projects with timeshares, and mandatory memberships like you see in Florida, New Jersey, etc. Now, at this point,
Awfully specific. Why are you attacking Jersey?
I mean, Jersey and Florida, man, they love the mandatory memberships. Jersey, it's the golf courses. I don't know what it is.
I mean, everybody's been attacking Florida all day, but I mean, like, why are you laying into Jersey, man?
I mean, they had it coming.
Probably.
So at this point, guys, our presentation is done. We want to open up the floor. I'm going to stop sharing my screen and we'll open up the floor to questions. I can find my cursor.
Just to confirm with the HOA single approval, that was about a 4-week turn time with FHA?
No. If we have to submit for an HRAP package, it's 4 weeks from when FHA receives that package.
Receives it.
But if we get all the documentation together, that it's the same, the documentation, whether we get the 17 documents we need for HRAP submission or whether we get the 17 documents we need and they meet the more restrictive requirements to say that they're eligible for SUA. The documents are exactly the same. So as soon as we get all the documents and they meet the single unit approval requirements, we can turn around that same day and say, get a case number signed. And then it's just waiting for FHA to create the condo project ID and the FHA connection, which is like 2 or 3 days.
Okay. Whenever you guys take on a rescue deal, can you ever use another lender's questionnaire?
It's my favorite.
Yeah.
I love approving files on other lenders' questionnaires. Questionnaire is just a tool. It's just a tool. Okay. I love my questionnaire. I love the questionnaire that Ian wrote. It's fantastic. I know where all the yeses and nos go, and I know what I need to document if any of the yeses or nos are out of place. Not a problem. I love my questionnaire. It's fantastic. I can use anybody's questionnaire. I can use no questionnaire. It takes me a lot longer because I still have to answer all those data points when I go to Fannie Mae and tell them this project is warrantable. I have to document all those data points. I love the questionnaire because it puts it all in a nice, neat package.
Right.
But I can use anybody's questionnaire or I can use no questionnaire.
That's great. Okay.
I just like I like to say that the questionnaire helps provide a clear reason for eligibility
Yes.
for our investors, correct? But like Joey said, we can work with another questionnaire. We can work with data points to fill in a questionnaire. We can use several data points.
Okay. Thank you. A trend I've been seeing is some HOAs are getting greedy and some of the fees that they're charging are absorbent. Is there any rules as far as what type of fees HOAs can charge, and as far as transfer fees, questionnaire fees, rush fees?
No, I mean, so unfortunately, that's not the HOA, that's their management.
The management company, yeah.
Right.
Management company.
So really we're at the mercy of that management company. I would say on average, our conventional review is about, would you say 8 to 11 days, Joey? But that is heavily contingent on the quickness of the management company their
Mhm.
responsiveness to our reach out up front. Because sometimes we reach out and we don't hear anything for a day or two, and we have to let you guys know we haven't gotten a response yet, so someone can light a fire under them. So, I mean, ultimately, we're at the mercy of the management companies and whatever they charge.
And it fluctuates from market to market. I
It
mean,
does.
obviously it's for some weird reason and happenstance, it happens to be more expensive to get a questionnaire ordered and filled out on the West Coast than it is on the East Coast. I don't get it. I don't know, paper more expensive out there or something. Yeah, it's we overestimate on purpose on our initial estimate. Okay, we overestimate on purpose. That way, if it ends up being more than that, we can let the borrower know, hey, it's gonna be a little bit more. I'm sorry, that's just what they're charging. It's not. We're not charging for you to review the docs. We're charging just to get the docs. That's what they charge for. Sorry. We overestimate on purpose, and there's still HOAs out there, professionally managed and self-managed, that don't charge the buyer to fill out that questionnaire. They don't charge us to request that questionnaire. So there's still a lot of files where it's free, or there's also a lot of files where we have a recent review and recent data that we can just transpose over from a already approved project. That data set is good for 12 months on an established project. We just transfer over the questionnaire from that file to this file, and that borrower doesn't pay a dime. Which is another a good thing for the marketing aspect of it. All the agents on the horn right now. The such and such HOAs approve it and move them for the next 12 months. Let's start farming. No questionnaire fees. Let's start farming. And yes, Miss Felicia, yes, we still get pushback from HOAs every single day. Some of them just don't want to fill out the questionnaire. Some of them will only fill out the Fannie Mae version of the questionnaire. Again, it's fine. I can use any questionnaire. I can use no questionnaire. It just takes a lot longer when I don't have any questionnaire, because I still have to validate all those data points to deem the project warrantable.
Wonderful. Well, Jordan, you want to wrap us up and conclude?
Yeah, no, that's perfect. Thank you guys so much for all the knowledge that you've kind of provided both to LOs as well as agents. And obviously, any agents on the call, welcome to reach out to your LO and pass this along to Joey and Ian to make sure that we get condos approved and help those buyers out. So, but thank you all for being on the call, and look forward to the next time we do one of these.